We trust that you enjoyed the big picture report that we produced to the end of June. We're now moving on to the asset market or the asset class report. And really, what we're looking to do here is just unpack a little bit of what has happened in various asset markets. We obviously have to start with what's happened in commodity prices because it feeds into the South African economy so powerfully and also into many of the bigger caps in South Africa. If you look over a 3-month view, you've seen fairly significant weakness in a number of commodity prices. Platinum, iron ore, all down around 10%. However, if you look over a 5-year view, looks a lot more positive, particularly the likes of iron ore, which has done very, very well as palladium, whereas platinum a little bit more disappointing. And then on a 3-year view, remembering that that obviously coincided with early stages of COVID, not too much positivity on balance of arguments there. Looking at currencies, if you take the rand over a 3-month view, down 6%. We'll look in a second at the rand dollar chart, and you'll see that it's obviously fought back quite significantly. But as you can see, relative to the pound, down almost 10%, and similarly to the Swiss franc. Looking back over a year, you can see down 16% against the US dollar and 20% against the euro, 21 against the pound, and 23 against the Swiss franc. And all of that is telling us that the dollar itself, as you can see on the right-hand side there, over a 1-year view, down about 4% against both the pound and the euro. So on balance of arguments, the rand has been weak on a combination of factors. We went to almost 20 to the US dollar, I think in large part on concerns about the South African position on Russia. And I think the US dollar also losing ground as we've seen interest rates hiking elsewhere in the world, and obviously people seeing value in other assets and other asset classes. As mentioned, this is just the rand to the US dollar. And as we often say, unfortunately, it's difficult to see that. But over a 10-year period, we often have these periods where the rand gets sold off very aggressively, very quickly, and then it spends often 5-6 years fighting its way back. And as you can see there, from just under 20 to the dollar, the rand has firmed up as we record this to about 1768. And quite interestingly, there. Looking as though it's broken through that 200-day moving average, which is actually quite often a very good predictor of the bigger moves. All right, just moving on to bonds, and we'll do both offshore bonds and then local. As we said in the big picture, the inflation that was brought on in large part by the Russian invasion of the Ukraine really ended what we would call the Goldilocks era, where inflation wasn't too hot or too cold, and it gave the central banks of the world the flexibility to remain incredibly accommodative. Inflation, it doesn't matter whether you're looking here at the US or in Europe, punched through that magical 2% mark and showed it a clean set of heels. In the US, it's come down quite significantly, although the core inflation number we think will trail that. But in the EU, inflation remains quite elevated. Just going to illustrate here the 10-year yield on a variety of countries, starting with the US. And keen market watchers will remember a time where lots of people in the market were saying, well, the 10-year is not going to breach 1.5, or then when it breached 1.5, said it would never go through 2. And we can see how it smashed through 4. It has subsequently come back to sort of 390 level, but still very, very elevated from where it was in that sort of surreal, very accommodative monetary policy environment in 2020 and 2021. UK yields similar, but actually moved even further. As you can see, the 10-year yield sitting at about 428 at the moment. a massive spike from 0.5% or even less in the depths of the COVID-induced seller strength. Eurozone, also, you can see in that sort of what we would call the irrational period from 2019 to 2022, where on Eurozone debt, people were happy to take negative yields. Those yields have gone up to sort of 2.5%, but from those negative levels, it's been a really bumpy ride for a lot of people. And I think as we look at that, we just need to remember that inflation in the Eurozone remains very elevated, and that means that bonds, even with yields having risen quite significantly, continue to produce very significantly negative returns. Okay, now we're going to look at the flip side of that. We looked at the yields. Now we're going to look at what prices have done. If you take the US Treasury basket, as you can see there, a massive sell-off from those highs in 2021, such that across the US Treasury issuance, you would have lost 19.4% of your capital from the peak to the current level. In the UK, the loss was even more significant. As you saw, yields have moved higher. Obviously, duration hurting badly there, where you would have lost about a third of your capital if you were invested, in a bond fund that tracked the UK Treasury government bond issuances. European bonds also very, very weak, and that was, I think, when we were often saying these negative yields create the perfect recipe for disaster, and here you can see it. Even with yields only at 2.5% and inflation still way, way up, EU bonds, the bond index has lost over a quarter of its value. And so I think the long and short is global bonds. We were very critical of the very low yields that people were prepared to accept, and warned that it was return-free risk, really. And I think that view has been borne out. Looking at local bonds, South African bonds have at times, through Nenegate and other things, and downgrades, seen yields get pushed to sort of circa 11%. More recently, bond yields have come down, so that we're back just above 10 on the 10-year. And if you look across the SA Govie index, which is across the issuance or the maturities across government debt, the SA bond market would have lost you around 8.5%. So ironically, South African government bonds offered a relative shield in sort of the holding currency relative to what other international bonds would have done. So our summary view is that if you take developed market bonds at 2.5%, 3%, 4%, the yields make more sense now, but they're still not a slam dunk, and we remain concerned, as we spoke in the big picture, about the significant amount of debt that is in issue and the ever-growing risk of devaluation. Local bonds yields also look compelling if you compare them with cash, but we would prefer shorter duration right now, where you get a little bit of yield pickup without too much capital vulnerability. But the short answer is that when bonds got hit a few weeks ago on the South African position on Russia and the Ukraine, there was probably a window of opportunity there. But increasingly, we're seeing more value and more opportunity probably in inflation-linked bonds than in traditional coupons. All right, moving on to equity markets. If you look at the more recent performance across global indices, obviously the 1 month is not terribly illuminating. It's safe to say that you can see there, the US markets, particularly ironically, the smaller companies, for example, measured here in the Russell 2000, up almost 8%, whereas Europe, China, all looking a lot less favorable, still positive, but not quite so. Again, you can see relative outperformance by the Nasdaq, with a 1-year performance of 32% versus a negative performance in China and Hong Kong. The FTSE in London, which obviously is very much banking and commodities driven, very lackluster, only up 5%. So really, the performance coming through from the techs and even the Dow Jones significantly lagging, like the Russell 2000, the S&P 500, which itself has been buoyed by the tech sector. And on a 6-month view, which is really what we would be talking to here, you can say the S&P 500, from that weakness that we saw late last year, has recovered quite nicely. That's up 16%, Nasdaq up almost 40%, whereas the Dow and the Russell lagging, and the FTSE and the CSI basically in China going nowhere. The Stoxx 50 has had a reasonably good run, and I think that's in large part because of the weakness that we saw in the months that followed the Russian invasion of the Ukraine. But all in all, I think what we're trying to illustrate here is very, very patchy performance. Performance very much driven by the tech sector. Looking a little bit longer term, we've obviously discussed the 1-year returns. If we look a little further out to the 3 and the 5, these are total returns, not annualized. Again, the Russell 2000 over 5 years is only up 15% versus a Nasdaq, which is up 115%. And again, you're seeing the impact of the tech stocks in the S&P. Sad to see over a 5-year view. This is just capital value, not total return. The FTSE 100 slightly negative on a 5-year view. The stocks is better, and yeah, Hong Kong's down over a third. So it's been a very, very fragmented performance. But importantly, we have to say that the S&P 500, which is the chart we're illustrating here, which saw a massive sell-off late last year, sort of middle to late last year, has recovered quite nicely, and that is in large part explained by this slide, which shows the top holdings in terms of market cap of what we call the new economy stocks. So Apple, Microsoft, Amazon, Alphabet, Meta, even Tesla, all contributing significantly, such that, sort of, let's call it the new economy stocks represents about 30% of the S&P 500. And we'll talk a little bit more about that when we discuss the portfolio performances in the subsequent videos. So in spite of the fact that there's probably a case to be made that the S&P is off its high and the world is sort of recalibrated already, we are of the view that there's actually quite significant risk on the short term in the S&P 500, because we feel we're going to see negative earnings growth, mainly because companies are having to absorb cost pressures, and the consumer would probably push back. And then on the medium term, if we look maybe a year or two out, we become more concerned about the growing prospects of a recession in the US. And then, as we showed, the Nasdaq almost back into record territory, and that really is what has been powering the S&P 500. We spoke about the FTSE 100, and you can see it's done very little, never mind over 5 years, even over 10 years. The Stoxx 600, which is a broader European benchmark, has recovered quite nicely after that sell-off earlier in the early phase of the Ukrainian conflict. It's recovered, but still not exactly shooting the lights out. But yeah, probably relatively good value relative to the US. The CSI 300, it tends to be quite a volatile animal. Obviously not incredible liquidity there, but as we saw earlier, significant weakness, particularly over the last year or two, and an area where we're actually seeing a fair amount of value. Looking to the local markets, and this is even more of a fruit salad than we saw in the global markets. If you look, for example, over a 6-month view, the top 40, which is obviously very dominated by maybe 5 companies that cumulatively represent about 50% of that weighting. That's up 5.5%. Whereas if you look down, basic materials, which is resources counters, down almost 12%. Small caps, mid caps, and even the local industrial board, Backling Industrials here, which is the Indy 25, has been significantly helped by an incredible performance from Richemont, as well as a more recent performance from Naspers. As you can see there, the tech sector, which is really Naspers, up almost 20% over 6 months. That's let's say the 6 months to the end of June, and on a 1-year view, up almost 40%. But as you can see, over a 1-year view, massive divergence in performance, and it's very well reflected in the divergence in the performance between the top 40 and the capped shareholder weighted, where the capped shareholder weighted has only done 8% versus the top 40 of almost 18%. Telecoms have had a good recovery over the last month or so, but on a 1-year view remains slightly negative. So I think the key here is that the local economy stocks over the last 6 months or year have had a really tough time of it, and it's really been down to the dual listed heavyweights. Looking slightly longer term, we've discussed the 1 years. If you look at the 5-year, for example, the all share lagging the top 40, just showing how, the extent to which the performance has been driven by Richemont, Naspers, and maybe Anglo's. As you can see there, over 5 years, the capped weighted has produced roughly half the total return, or sorry, the capital return that the top 40 has. Tech has had a massive recovery. Basic materials off that low that we saw, around the Anglo-American sell-off about 5 years ago. Those were the 2 star performers. Industrials, generally, those are the local industrials. Listed property have been absolutely hammered. So effectively, over 5 years, the capital value of the listed property index still almost half of what it was, and you would have lost around a quarter of your capital had you been invested in local industrials. Small caps, which is not a great benchmark because it's really just a handful of small caps, done relatively well, but mid caps not doing much. And as you can see there, telecoms, for example, banks, very, very pedestrian returns over capital returns over a 5-year view. So really the message here is tech and the likes of the commodity players, Anglo's, BHP Billiton, and Richemont really have driven the market. The South African equity component has been very, very poor, frankly. Just very quickly looking at the top 40 index, again taking cognizance of the extent to which Richemont and Naspers and Anglo's drive this performance. It's been an okay performance, but helped obviously by the currency. This chart we thought worthwhile because it illustrates, and we'll unpack this in more detail in our local portfolio review. But really what we're illustrating here on the x-axis is the PE multiple, and on the y-axis is the earnings growth. And we're generally using 2, sometimes 3 financial years being the current and the next, or the current and the next 2 if earnings are expected to be released soon. And as you can see, that green block shows companies that are on multiples of 5 to maybe a little over 10, maybe 11, and a lot of them delivering 10, 12, up to 18% earnings growth. And that leads us to conclude that there's actually a lot of value in the South African equity market. And as you can see there, companies like Amplats and Kumba and BHP still delivering negative earnings growth on the next 2 financial years. So although maybe not expensive, they are not giving you the earnings growth that those local economy stocks in that green block are talking to. Then we think this is probably a brilliant metric just to show how much value there is and how cheap South African stocks are and the extent to which they've underperformed. This is the long run PE of Standard Bank. That's the red line. The blue line is the historic PE. As you can see, the current PE is 10. The forward is even lower than that. It's probably around 8 times versus a long run PE of around 13%. And that shows, just how cheap it is. The last time we were here obviously was with the COVID scenario, and then before that, last time we saw valuations this low was in the sort of apocalyptic GFC environment. So lots of value, we believe, in South African equities. Property, the combination of COVID, e-commerce shifts, and interest rates really hurt global property. This is a global property REIT, and as you can see, over a 10-year period, still down from an initial level here in terms of price of 26 down to sort of 24, so lost about 8% of value over that 10-year period. This ignores yield, but more recently yields have been very, very thin on these global property counters. So the world battling to readjust and recalibrate. And one of the problems is that there's a lot of stock, whether it's retail or commercial, we're talking office, in this sort of post-COVID world where companies have learned to operate with significantly less space, we believe is going to continue to weigh on traditional property counters. The JSE listed property index, if you look over 10 years, also trading at about a half of the level that it was at. The value destruction has been phenomenal. Yeah, just really disappointing performance. A lot of people have held the view that property is, safe as houses, no pun intended. And this chart shows the degree to which that was a false narrative. Okay, very quickly, our summary on property. SA property yields look attractive, but we don't think the story is compelling. We still feel most of the companies are invested in traditional commercial and retail, and we think that world is going to be very tough for a while. Global property looks better, but we feel you have to be selective, both internationally and in South Africa. And I think you need to understand that rates could surprise a little bit for a bit longer. And as such, we feel you need to be patient. Our bias really is towards more new world sort of industrial with a focus on DCs and logistics. We feel that that's probably the space one wants to play in. So in overall summary, we feel that US equities continue to look expensive, particularly the new economy stocks. Europe and the UK look a lot more sensibly priced. China is looking cheap, particularly if there is some stimulus and if the Chinese authorities allow that economy to blossom. We would generally probably prefer corporate debt over government debt for all the reasons we've discussed. We think the South African equity market is, we say incredibly, you can almost say ridiculously cheap. We sense the rand is oversold, although it is a little bit binary because we're just operating in such a volatile world. We think bonds offer decent yield pickup, but we would actually probably either prefer inflation links or big bank prefs. We think there's actually a special opportunity in big bank prefs. And that's really it. We thank you for your time and attention. We trust this was of value to you.